pump with the fans. Pump with the pump with the pump with the fans. Pump with the pump with the pump with the fans. Pump with the fans. Pump with the fans.
Assalamualaikum and very good day to everyone. We are from Mega Achieve Group and today we will be presenting on the importance of rate ethic and the best accounting concept in the preparation of financial statement. This presentation is part of our coursework under course learning outcome 3 CLO3, which emphasize the current application of accounting treatment based on approved accounting standards and ethical practice. In this presentation, we will discuss 11 fundamental accounting concepts including historic cost, prudence, consistency, matching, and others. This concept is not only guide the preparation of financial report but also reflect to our responsibility towards ethical business practice.
So this is my team members, Shazrin, Adriana, Ratu Aini, Irfan, and me, Ahmad Mahamka.
We will also explore various types of source documents used in business activity and explain their function. Each of us will be contribute to this presentation and our individual part will be clearly shown on the screen.
So, historical cost is an accounting concept that refers to the original monetary value of an asset or liability at the time it was acquired or incurred. This value is recorded on the books and does not change with market fluctuations. So for example, if a company buys a piece of equipment for $50 in 2020, it will continue to show that asset on the balance sheet at $50, which is minus any depreciation, even if the market value changes in the future. So for the advantages is simplicity and clarity, and avoid subjective valuation. And the disadvantages is can be outdated or misleading in times of inflation or market volatility, and doesn't reflect current market value.
Prudence principle in accounting. So the prudence concepts means that we should exercise caution when making accounting judgment, especially when there is uncertainty. It's about not overestimating assets or income and not underestimating liabilities or expenses. In other words, we should always be realistic and avoid presenting an overly optimistic view of a business financial position. The goal of this principle is to protect users of financial statement, such as investors, creditors, and regulators from being misled. By applying prudence, we ensure that financial report provide a true and fair view that doesn't exaggerate the company performance or financial health. Next, I want to talk about consistency in accounting. The consistency principle means using the straight line method to depreciate its machine. It should continue using that method every year. This makes it easier to compare financial statement from one year to the next. If a company changes its accounting method, it must explain why the change was made and how it affects the financial results. Consistency helps make financial information clear, reliable, and useful for decision making. We'll continue about matching principle in accounting. The matching principle is an important rule in accounting. It says that expenses should be recorded in the same period as the revenues they help generate. Why does this matter? Because it gives us a more accurate picture of how much profit a business really made during a certain time. Let's say a company sells a product in April, but they bought the material in March. Even though they paid in March, the expenses get recorded in April. At the same time, the sale happens. This way, income and expenses are matched together, making financial statement clear and more useful for decision. So remember, the matching principle helps us see the true performance of a business by matching costs with the income they help create. Now we talk about accrual. Accrual accounting is an accounting method that records financial transactions when they occur, regardless of when cash is exchanged. This method ensures that revenues are recognized in the period when they are earned, and expenses are recognized when they are incurred, rather than when the money is received or paid. Inaccurate accounting transactions are recorded as soon as they happen, even if the cash flow happens later. This allows business to report their financial performance based on what has happened, not just what money has been exchanged.
Materiality concept. This concept states that all significant information that could influence the decision of users must be included in the financial statements. In fact, insignificant details which do not affect the overall understanding can be omitted or simplified. For example, a small expense of 10 ringgit for stationery might be recorded directly as an expense instead of being treated as an asset due to its material value. Next is going concern. This assumes that a business will continue its operations for the foreseeable future and has no intention or need to liquidate or significantly scale down operations. This assumption justifies deferring some expenses to future periods. For example, when valuing long-term assets, depreciation is applied annually based on the assumption that the business will continue using those assets over time.
So objectivity means that the information in accounting should be based on facts, not opinions or guess. Everything recorded should be supported by real proof like bills, receipts, bank statements or contracts. Why it's important? It makes sure the numbers are true and trustworthy. Secondly, different people should be able to look at the same information and agree on what it means. And lastly, it helps stop cheating or lying in financial records. For example, if a company sells something for $1,000, it should show that sale using the invoice or receipt. It should not just guess the amount or write what they think it was. So money measurement. The rule says that only things that can be measured in money are recorded in accounting. If something cannot be given a money value, it is not recorded in the accounts. For example, if a company buys a machine for 10,000, that is recorded. If the company has a happy and skilled time, that is important, but it's not recorded because it cannot be measured in money. For the key points is only financial money-based information goes in the books. Non-financial things like employees, loyalty, good reputation are not recorded even if they matter to the business. Business entity concept. This rule says that a business is separate from its owner. The business has its own money, its own accounts and its own records, even if one person owns it. For example, if the owner used $1,000 of their personal money to buy something for the business, it is recorded as the business receiving money from the owner. It's not just the owner buying something. For the key points is the business and the owner are two different persons in accounting. The owner's personal expenses are not recorded in the business books. This helps keeps the records clear and accurate.
Periodic concept. This concept assumes that the life of business can be divided into specific time period. For example, monthly, quarterly, annually for reporting purpose. Financial performance and position are assumed measures and reported over these distinct period to provide timely and useful information to stakeholders. For example, a company prepares quarterly financial reports to assess its performance for each 3-month period.
Let's begin with invoice. An invoice is issued by the seller to the buyer after the product or service is provided. It includes details such as items sold, price, quantity, and the total amount due. The main function of the invoice is to request the payment from the buyer and to record a revenue in the seller accounting records. In another word, it acts as a proof of sales. Next, we have the receipts. A receipt is given by the seller to the buyer after the payment has been received. It usually includes the amount, paid date, and a payment method. Its main function is to confirm that payment has been made. Receipts are important for both the buyer and the sellers because they serve as evidence of the completed transaction and are used to record cash or bank inflows. Now, let's talk about purchase order, also known as PO. As purchasing order is created by the buyer and sent to the seller to show their intention to purchase specific goods or services. It includes details like item names, quantity, and agreed price. The function of the PO is to authorize the purchase and to help the businesses control the inventory and budgeting. It also serves as an official document for approval and tracking. Last of my part is we have the delivery order or DO. This document is issued by the seller when goods are delivered to the buyer. It contains information like delivery dates, item list, and quantity. The main function of the delivery order is to confirm that goods have been delivered. It's also used to track inventory and it often needs to be signed by the receiver as a form of proof.
So, debit notes. Debit notes is a commercial document issued by a buyer to a seller indicating an increase in the amount the seller owes the buyer. It serves as a formal request for debit notes or correction. So, this is an example for debit notes. In debit note format, you have a name, address, and GST of the supplier. Second, nature of the document, unique series, and the date of issue of the debit notes. 3. Sales number and date of the corresponding tax invoice of the bill of supply. 4. Value of the table, good and service involved in the seller transaction. 5. Tax rate and the amount of the tax be debited to the recipient. And last, signature or digital signature of horizon supplies. So, what a procedure for debit notes. Procedure debit note: the supplier should furnish detail of a debit notes with filling written for the month in which the debit note was issued. The tax liability will be adjusted accordingly. Time limit: debit notes have no time limit. However, once a debit note is issued, the supplier should declare it to the monthly return no later than the following month. So, credit note. Credit note is a document issued by a seller to buyer, reducing the amount owed due to return, error, and adjustment. So, the process credit note is issued by first, buyer 1 purchase item from seller A, who also provide a tax invoice. 2. After noticing some quantity problem, buyer B return the supply good along with a debit note. 3. After accepting the debit note, supplier A acknowledge buyer B with a credit notes. So, what time or duration for credit notes? Both debit notes and credit notes can be issued at any moment. Debit and credit notes must report in the GST return submitted for the month they will issue. Type for credit note have a 6. First, select the credit notes design that will be asked. 2. Refresh the company logo. 3. Enter the credit notes EQ credit number and issue date. 4. The reference to the invoice that the credit notes is issued with. 5. Along the location of supply, add the GST for the supply and the customer. 6. And keeping the credit notes safe. Format for credit notes. Credit note is a formal document delivery to customer by a company. Financial division. A credit note is also issued to the invoice is if the seller or order needs be cancelled or modified. It functions as a legal document that enable you to update an invoice without initiating or otherwise charging. And last is a bank statement. Bank statement is a summary of financial transaction in a bank account over a specific period. It is issued by the bank to the account holder, individual or business, and serve as an official recording deposit withdraw, and feed and interest. So this is an example for statement bank. So how you can get a statement bank? So typically you can access your latest bank statement on your financial institution website. For example, CIMB Click or MyBSN. Or otherwise, you can request a monthly paper statement be delivered to your home. Benefit of bank statement. Bank statement are a great tool to help account holder keep track of their finance, identify error, and recognize spending habit. Type of bank statement. Many banks offer account holder the option of receive paper or electronic statement, usually via email. So that's all for the presentation. I hope my group is the best. Bye bye.